Today we have two great presenters, Erin Pirro and Keith Dickinson. They are experienced consultants with Farm Credit East that work with businesses throughout the Northeast in farming, fishing, and forest products to address various management and financial issues. Erin Pirro is also the manager of our Agricultural Retail Benchmarks program. Both are experts in the Paycheck Protection Program and have been involved since the very beginning of since the inception of the program. This information is current and accurate to the best of our knowledge as of this time. SBA continues to make changes and legislation continues to be debated that may change some of the terms of the program. Under Knowledge Exchange, you can access the COVID-19 Resource Hub. On there is information on the Paycheck Protection Program, as well as several other COVID-19 related relief programs and information. We update it frequently, and I would encourage you to check that out.
And I'm going to turn it right over to Erin Pirro, who's going to kick us off this morning.
All right. Thank you, Keith. And good morning, everyone. Just a quick start from the very beginning to refresh our memories that the Paycheck Protection Program was started in very, very late March of 2020 with the goal of keeping employees paid during the COVID-19 shutdown. Because there are a lot of businesses that could not have employees report to a physical location, those employees were essentially laid off and not able to keep working, but still needed to be able to put food on the table and pay rent and other basic necessities, would have naturally gone to unemployment. But of course, that was overwhelming the system as well. So the government thought, hey, who better to keep paying people than their employers? So here is some money for you to be able to do that. Small businesses were allowed to apply for the PPP loans in order to cover payroll and a few other eligible expenses. And the amount that a business could apply for was based on their average monthly payroll in 2019. They were able to borrow 2.5 times for about 10 weeks worth of payroll. Each business entity was allowed one loan application and therefore one loan once approved. And if as a borrower, the SBA approved your loan and you spent the right amount of PPP funds on the right expenses in the right time period, you could apply to have the loan forgiven or partially forgiven, depending on what made the most sense for your financial circumstances.
So as Erin mentioned, this program is a loan program that has some unique provisions that allow for forgiveness. And we're going to be talking mostly about forgiveness today, but just as a refresher on the terms of the loan, and this has gotten a little bit different as we've gone through. There were some changes made in June, and specifically on June 5th, when Congress passed an additional law changing some of the terms of the PPP program. And that changed the actual term of the loan portion of the program for certain borrowers. So if your loan was made prior to June 5th and you got your money based on a loan that was approved prior to June 5th, your loan has a 2-year term with a 1% interest rate, 100% paid back within 2 years. If the lender and borrower, both you and your bank, mutually agree, you can change that to a 5-year term. Again, it must be it must be agreeable to both the lender and the borrower for that change to be made. Now, if you received your PPP funds after June 5th, it's a 5-year term at a 1% interest rate. Interest rate didn't change, but the term of the loan changed from a 2-year to 5-year. We know there's been some confusion. There's been some folks who thought that everyone retroactively went to 5 years, and that's not the case. If you had a loan prior to June 5th, you still are with that original loan term according to the loan documents that you signed when you closed on that loan. And then for all loans, if the application for loan forgiveness is submitted to that lender within 10 months at the end of your covered period, and we're going to define that here as we go today, no payments are due. Originally, if you recall, June 5th, prior to June 5th, with the old rules, there was a 6-month deferment on the first payment. Well, now essentially there's a 10-month deferment as long as you get that application for forgiveness in your lender's hands by the end of that 10-month period.
So what's it going to take to get these loans forgiven? First, a borrower needs to compile a lot of documentation to support their application for forgiveness. You have to do that either at the end of the covered period, which is the time in which you are given to spend the PPP funds, or there is a provision where you can apply after you've spent all your funds. That comes with a caveat because there's a few things SBA hasn't told how you prove if the time period hasn't finished out yet, right? That's a nuance. I can't say something happened in a time period if the time period hasn't finished yet. Once you have put your package together, you're going to submit it to your PPP lender, and then that lender will submit that package to SBA for forgiveness. The lender will then hear back from SBA on how much of the forgiveness has been approved. The lender then notifies the borrower in this phone tree, and any remaining balances need to be sorted out in terms of what the payment schedule on that, if there's any left over after forgiveness has been applied. And that's important because anybody who received an EIDL advance is going to have a loan left over, and Keith will get more into that in a little bit.
So how does PPP loan forgiveness work, and what changes have made as a result of the Forgiveness Act that was came to bear on June 5th? So originally, when most of you got your loan, the vast majority of loan volume occurred prior to the passage of the so-called Flexibility Act. The rules were that you must spend those loan proceeds within 8 weeks. At least 75% of that amount must have been on payroll, and then no more than 25% of your loan amount could be spent on qualified interest, rent, and utilities. And we'll get into more definition of those non-payroll expenses here in a bit. So now, since those rules have changed, everyone, and this is retroactive for every PPP loan that has been made since the beginning, you now have this 24-week period to spend the period, or December 31st of this year, whichever comes first. And coincidentally, that's today. Today is the day when from the day forward, any new PPP loan will have less than 24 weeks based on that December 31st deadline. Unlike the 75% threshold that was in the original rules, now there's 60% must be spent on payroll, and then no more than 40% on those non-payroll expenses of interest, rent, and utilities. And then, of course, if you applied prior to June 5th, you may elect to keep the old rules, but we're going to focus on the new rules today, what you see on the right side of your screen, the 24-week covered period and the 60% on payroll, 40% on non-payroll expenses, because those are the rules that everyone has by default. But again, recall, you do have the option, if you were able to spend your money in 8 weeks and meet all the other criteria, you can elect to use those rules instead of the 24-week rules.
So timing is what's really important about this, because you've got to spend that money in the right time period. And then you need to keep forgiveness on your desktop so that you don't forget about it. It's far enough out where if we put it off, we're likely to forget about it. We don't want that to happen. The trick is we can't rush at it yet because we're going to have a lot of documentation that we still need to gather on time periods that haven't happened yet. So the things that we're suggesting you mark on your calendar are your covered period, which is a 24 weeks starting on the date you received your PPP funds. So find that on the calendar, circle it, and then highlight the 24 weeks that start that day. And if it starts on a Tuesday, it ends on a Monday. You don't need to rush for your forgiveness application. You need to keep some things in mind, like concentrating on spending the money on payroll. And as Keith said, you aren't going to have to worry about a loan payment until 10 months after your covered period. We recommend that you apply for forgiveness when you've spent all your PPP funds on eligible expenses, prioritizing payroll if you at all can, and when you have all the documentation in place and the bank is ready to receive the application. As of this moment, I don't know of any banks that are actually taking PPP forgiveness applications because SBA has yet to tell them exactly what to do with it once they receive it. And chances are, if a bank makes up the form in which they are going to receive it, that's not going to match what SBA eventually says, and we're all going to have to redo all the paperwork and formatting anyway. So let's just sit tight, get the instructions, and do it once. The other thing to keep in mind is that taking a PPP application starts a clock ticking, so it's putting banks in a squeezed position if they are to take an application now and then don't have any instructions from SBA on what to do with it. So that's why there's some delays in the process while everyone is waiting to understand exactly what is expected of them. So the other thing to think about with your own documentation is if you're going to have to submit payroll tax returns, and we are now just into the third quarter of the year, practically speaking, we need to finish out the third quarter, which would end September 30th, and then file the payroll reports, if you're a quarterly filer, before you can apply, because you're going to need to have that report in your your forgiveness application package. So as we've noted here, that'll be October for a lot of folks who are quarterly filers and have finished spending their money or their covered period by the end of September, or January for any of those 943 filers who are listening, because you need to complete the time period for which your payroll tax return covers, and that's an annual form. So it means 2020 needs to be over before you can submit the reporting that's related to it.
So some of the basics on this covered period we're talking about. So as we've said, that's the amount of time that you had to spend those PPP funds. It was originally 8 weeks. It's now 24 weeks, 6 months roughly. It started the day that the funds hit your bank account, date of disbursement, the date that ACH was initiated, when you have when the money was showing up in your bank account. That's the day that your covered period started. Again, it's 24 weeks, and it's even specific to say 168 days. If you got the money on a Friday, it ends on a Thursday. It's very, very specific to that point. It's not, rounded to the nearest full week. It's not rounded to the nearest month. It is exactly 168 days. It ends no later than December 31st. So again, if your date of disbursement is after tomorrow, July 24th, that's tomorrow, then you will have less than 24 weeks in your covered period. So if we have anybody on the call who has just applied and the money hasn't been dispersed yet, then you're going to have some interesting math and some of the averages and calculations that we have in documentation, because you will have a fraction of 24 weeks. So some of you may be thinking, well, this is kind of crazy. My pay period doesn't coincide with when I got my money. How do I figure out my payroll? And Erin is going to introduce that idea for us.
So if you choose to use the covered period, it is the 24 weeks, not months, exactly weeks, that start the day you got the money. So in this example, that money was received on May 7th, which means we need to count out 24 weeks. That's what's highlighted in green. And then we need to count all the payroll that was not only incurred, meaning the money your employees earned during that time period. We also get to count what was paid during that time period, even if it was incurred earlier. Now, this really complicates things, and I think was much more important when we only had 8 weeks to spend the money. But if you think about how much you borrowed, 2.5 months of average payroll, which is about 10 weeks. And now you have 24 weeks to spend it. That really shouldn't be too big of a hurdle. So the first thing I would do is run a report for your payroll that covers May 7th through October 21st to see how close I am in spending all of my PPP funds on payroll in that time period. If I need to, I am also allowed to count a few other things. For instance, at the very end of this pay period, we see October 18 through 21. That's only a partial week, but those 4 days count if I pay them on the normal pay schedule, which will be outside the covered period. So again, it's incurred during the covered period, but paid later as normally scheduled. If I really, really need it extra, I can also count the pay runs that were at the very beginning of my covered period, even though those were incurred before my covered period started. So on my Sunday to Saturday pay period of April 26th through May 2nd, I don't actually pay that payroll until May 8th. That one will count if I need it to. So you have lots of cushion in here to be able to count actually more than 24 weeks worth of payroll if you absolutely need to.
So just in case that you don't have enough time period or you want to simplify this even more, this was a change that came through, or a piece that came through in the original forgiveness rules, and it did carry forward into the 24-week period, is this idea of an alternative payroll covered period. And you'll see it abbreviated APCP throughout the rest of the presentation. That allows you to have a different covered period for payroll-related expenses only that aligns with your pay periods. So it starts with the first day of the first pay period that immediately follows the disbursement dates. So you look at, say, if you got your money on a Friday and you pay Sunday, your pay period starts on a Sunday and ends on a Saturday, for example, you would skip forward to that next Sunday, and that's the first day. There are a few caveats. You must use biweekly or more frequently. So if you pay monthly, you pay twice a month, or anything that's less frequent than every 2 weeks, you can't use this. You have to use the covered period, the original covered period. But you can use this alternative payroll covered period if you're paying biweekly or weekly or daily, if there is anybody doing that. Now, if you use that for payroll, you must use it for all of the payroll calculations. So, and we'll get into that. Some of the FTE calculations, some of the wage reduction factors, all of those must use that. You have to align those together. And there are some other expenses in some instances where you are required to not to use a covered period regardless, particularly with those non-payroll expenses. So this only applies to payroll-related expenses where it specifies it. And then finally, if you do choose to use that alternative payroll covered period, you must pay that last pay run by its normal pay date. You can't manipulate the timing of your paying, of when things are paid. Everything has to be paid on time. And again, Erin's going to give us a visual representation of what this looks like.
So in this example, we still got our money on May 7th. However, we thought it would be a lot easier to just line up our covered period with our pay runs so that we knew we spend the payroll money from Sunday through Saturday, and that is a pay week. So the 10th through the 16th would be our first pay run. So this makes reporting a whole lot easier because it's going to match up the time period with the payroll report that we are going to run for 24 weeks straight. As Keith said, it starts the first day of the first pay period after we got our money, so that's the Sunday, and then continues out for 24 weeks. So that would be the first payroll report that I would run. Very easy to match up to any of the other documentation you need to provide. You will need to do all your FTE and wage calculations for this time period, so it'll make reporting a lot easier, but you have to be consistent throughout. And just like the regular covered period, you'll have an option to include a pay run that was paid in the covered period, but not incurred, meaning the May 3rd through 9th payroll is actually paid on May 15th. That could potentially count if you need it to. And the last week, as Keith said, as long as it's paid on time, that would be October 18th up through the 24th, would be paid on, let's see, that's kicking now into the next period outside of our covered period. But as long as it is paid on time, that one can still count as well. So if we want to keep it simple, think about an alternative payroll covered period for payroll only, because it will match up with the payroll reports you're going to run and save you a bunch of math.
So sort of a summary or again, a more detailed look of this covered period again versus that alternative covered period. Again, the covered period is the period that started a date that you received your loans and ends 168 days or 24 weeks later. It is that period that you must spend all of your loan proceeds on qualified expenses to achieve forgiveness. The alternative payroll cover period, in contrast, is an option for payroll expenses only to allow you to align your reporting of forgiveness and your qualified forgiveness in terms of payroll, allow that to align to when your pay runs occur so that you can make the reporting easier and make the math easier for that. But again, it only applies to payroll.
So to recap, the alternative period is the one that's going to start on the first day of your payroll period that starts following the day you received the funds, and it ends 24 weeks later for anyone that's received a loan already. If you receive your loan tomorrow or after that, then you will be limited from whatever day you get the funds until the end of the year. You need to pay at least with a biweekly frequency or a weekly frequency, right? Something shorter in order to use this alternative covered period. And again, it all gets cut off at December 31st. So the end of your covered period, your alternative covered period, or the end of the year, whichever comes first.
So switching gears back to the big picture, what counts towards forgiveness? Payroll. And that's, we're going to emphasize payroll today. Payroll is your gross wages to the U.S. resident. You can maximize up to $46,154 per employee in that 24-week time period. That's the equivalent of an employee who is making the equivalent of $100,000 per year. That's the maximum that we can count towards forgiveness. And then it's the employer share, your company paid share of healthcare benefits, retirement benefits, and those state and local payroll taxes, primarily the unemployment tax that you pay to your state. The employer share of Social Security, Medicare do not count, nor does federal unemployment tax or workers' comp. And withholding taxes do not count as well. Those are already included in that gross wages that you're already getting to qualify. And if this sounds familiar, it's because these are the same expenses that you use to qualify for your loan eligibility. So it should be fairly familiar to you and fairly easy for you to pull that information together once we get to that point. And again, paid and incurred, you can't make prepayments of payroll. So you can't give a bonus in advance. The bonus has to be actually paid in that time period or paid on time if incurred during that time period.
What does paid and incurred mean? A paid paycheck is just what it sounds like, right? The date you hand over the check or the day you originate the ACH. An incurred payroll is the day that the employee earns the money by working the hours. Okay, so those are pretty simple. That is an odd mix of what we would call cash accounting and accrual accounting, but that's the way Congress wrote the bill. We also have a couple of other options if you need them. And again, I say if you need them, let's not complicate things needlessly, which we're letting you know what the instructions say so that you can make the best decision for your business if you need to include these extra funds. If you incurred the expense but did not pay it during the covered period or alternative covered period, such as those last 4 days that still count within my 24 weeks, but it's part of a week that I wouldn't pay until the following week, those 4 days worth of payroll count as long as I pay them on the normally scheduled pay day. And the other caveat is I need to allocate out only those 4 days of payroll count. The whole week does not count. So that's going to require a bunch of extra work, which is why we suggest run the report for the 24 weeks and see how it goes before you jump into the rest of it. And then there's also the paid but not incurred, meaning the week before you got the money, does that payroll count? Yes, it does if it was paid inside the covered period. You handed the employees the check for the previous week on that day inside your covered period, or sent them the ACH, you can count that as well. But as you can see, now we're mixing and matching a lot of different reports, and that's going to make for more onerous accounting.
So what about owner's compensation or compensation from self-employment? Again, as you recall from the loan application process, this was a moving target throughout the process. And similarly, it has been a bit of a moving target throughout the forgiveness. But the rules we have at the moment is that, if you're self-employed individual, that paycheck was calculated based on the 2019 tax return that was submitted with your application. Now, some of you submitted a draft version of that 19 tax return because you hadn't actually filed your tax return yet. That was, and of course, the extended deadline was July 15th, which was middle of last week. So unless you went on extension, most of you have filed that final return. And so for sole proprietors, as a reminder, what was the amount that you qualified for? This is also the amount, more or less, that's going to be qualified for forgiveness. Your Schedule F or Schedule C profit, depending on whether you file a Schedule F or Schedule C with your sole proprietorship. The sole proprietorship has one owner, even if the owner is married. There was some confusion over that during the application process that we ran into with customers we worked with, is that if you are a sole proprietorship, if you're filing, a Schedule C or Schedule F even if it's on a jointly filed return, it's the name at the top of that Schedule F or C that is the owner of the business, regardless of whether it was a jointly filed return or not. So if you're in a partnership, it's box 14A of that Schedule K1, and it's the profitable one. So we see one sometimes where we have a positive number and we have a negative number, and some partners might have a positive number in box 14A. Some partners may have a negative. Only the positives count. And it's not an aggregate. That's another point of confusion. You don't have to add them up. You just add but it's based on the total of all the positive box 14As of your K1s. But again, it's very specific to that. I mean, it's not just a box or a form. It's the specific box on a form. Now, if you're an LLC, you use your applicable tax filing. If you're taxed as a sole proprietorship, you use the Schedule C or Schedule F. If you're taxed as a partnership, box 14A. And if you're taxed as a corporation, your owner's pay is included as salary or wages. There's no additional self-employment income. So distributions, dividends, they don't count. It's only the owner's salary and wages, and it's specific to what you paid yourself in 2019. So the amount that's eligible for payroll, it's not a full 24 weeks. It's 2.5 divided by 12. So you take the amount that you were paid in 2019 based on those different scenarios and above on the middle part of the slide there, depending on what your business structure is. You take the amount from 2019, you divide by 12, multiply by 2.5, and it's maximum of $20,833 per owner or partner. This will match what you qualified for, were allowed to include on your 2019 or based on your 2019 earnings from your loan application. The exemption may be that some of the corporations, it may be slightly different because it's a little bit different how we're calculating this for forgiveness than it was for your loan application in some cases. But in most cases, it'll be exactly the same.
Okay, so recap: owner employees for corporations, self-employed individuals who are sole proprietors, and partners in partnerships. You're going to need to report your earnings on your forgiveness application separately from that of your employees. It is evaluated differently for the reasons Keith just went through. Your threshold is based on what you applied with on your 2019 tax return. So you could double your pay this year, but you don't get to have anything more count towards forgiveness than what was eligible for last year. Your payroll costs do count towards forgiveness based on the 2019 compensation that you received from your company. Your hours, though, do not count towards FTE calculations. And theoretically, if you were full-time before COVID, you're full-time now still. It doesn't have a practical implication other than knowing don't clutter up the application with unnecessary information. The one thing we want to make sure everybody is crystal clear on is your 2019 tax return is what determines your portion of the forgiveness for your, quote, paycheck as an owner. So if you had a draft Schedule F that had $100,000 of profit on it when you applied for PPP, then you worked with your accountant and your accountant said, oh, no, we got to depreciate all this. You're going to have a $50,000 profit on your Schedule F. That filed Schedule F is what's going to be your forgiveness documentation and dictate how much of your, quote, paycheck is eligible for forgiveness. And it's going to be half as much as you applied with because that's the documentation that's required. That's why we've included this warning on all of our forgiveness webinars is make sure when you do a draft, it matches what you actually file. So worst case scenario, you may end up with a loan that you need to be paid back, and we don't want anyone to be surprised by that.
So also in the interest of no surprises, what about if we're using H-2As, H-2Bs, J-1 employees, these guest workers? The SBA guidance, there has been some guidance, or we're really just one frequently asked question answer by the SBA that talks about this issue of not payments to individuals who are not residents of the United States. Those were considered ineligible for the program. The guidance that the SBA did provide does not mention specifically H-2As, H-2Bs, J-1s, any of the guest workers program. It does not mention that at all. So we don't have clear guidance there. The guidance that they did issue essentially points to the IRS regulation that is used to determine your residency of where you pay income tax, what state, and then also whether it's also used when you determine whether or not it's your principal residence for determining whether or not capital gains are owed when you sell your house. It is not an IRS code that has anything to do with an H-2A program. So we don't have official word. We don't feel many banks are going to be willing to jump out on a limb too far. So the safe bet is that H-2A, H-2B, J-1, if they don't meet that IRS test, which is very comprehensive in terms of where they get their mail, where their kids go to school, things like that. If they don't meet all of those tests, they're probably not going to be considered a resident of the United States. So we recommend that you plan your spending and forgiveness application without including those wages, because we feel that's the very safe bet in this case.
And they weren't part of your application, as Keith said, so their accounts weren't figured in when you were borrowing either. And I think that's super important to remember because there's been a lot of mixed, interchangeable use of words that do not mean the same thing. A citizen and a resident are two very different things. So make sure you're focusing on residency, because there are U.S. citizens who work for companies, but they are residents of other countries because of their job. They don't count just because they're citizens, and vice versa. Just because you're a resident here, right, doesn't mean you're a citizen. Make sure you're focusing on residency. All right, so what else is eligible? We're focusing on payroll because, one, it's the Paycheck Protection Program, and two, you're going to have to do all the math related to payroll. So if you can make it all work with payroll, then it saves you a lot of paperwork for the other areas. However, if you cannot make it work with just payroll, you are eligible, or you have the opportunity to use the PPP funds for other eligible costs. that were paid during your covered period. You don't get the alternative covered period for the other expenses. So now you're going to be keeping records for 2 time periods if you're using the alternative covered period and having non-payroll expenses. These need to be incurred during your covered period and paid on or before the next regular billing date. So your June electric bill that's paid normally in July, if June was in your covered period, that counts. You can include amounts incurred even if the bill and the payment and after your covered period, but you have to do the math to say how much was actually incurred during the covered period and show your work to allocate that amount. Key, very key, your obligations must have been in place in writing before February 15th, 2020. You cannot prepay things to make them count during your covered period. And you heard us say many times during the beginning of this, what's the optics of me doing this? If you wouldn't be proud to see it written on the front page of a major newspaper, don't do it. So we still have people asking, is it okay to put my kids on payroll? Well, are they actually doing something useful for the business, or are you just trying to use up money so you don't have to pay it back? I think that's the question that you've got to ask, especially if those kids have never been on payroll before. Now, is there a good case for it because they just turned 16 and they need a job and they're doing things for your business? Absolutely, that's normal, right? That's how it happens in business, and it just happens to be happening during COVID times. But if it's, oh, I have a grown child who lives in another state that doesn't actually do anything for my business, but I'm going to put them on payroll right now, that'd probably be a little bit harder to answer that question if I was asked under audit, which SBA has a long time to do. So you're going to keep some paperwork for a while.
So get into a little more detail on these non-payroll expense covered mortgage obligations. So these are business, and make sure you notice that it says business, not personal, mortgage interest, no principal, only the interest. The payments must have been made during the covered period only. The alternate payroll covered period does not apply, or incurred during the covered period and paid as scheduled. So if you're on a monthly payment schedule and your covered period ends 2 weeks into the month, then you can prorate that 2 weeks out of the month and count that amount as long as you make the payment on time. It is on real or personal property, so both on your land mortgages, but then also on things such as equipment and inventory and other personal property. The loans must have collateral. Unsecured debt does not count, such as credit cards. Operating loans. So we get the question, what about my operating loan? Well, the answer is it depends. If it's covered by collateral, which if you go through a traditional bank or, even say Farm Credit, most of those operating loans do have collateral assigned to it. But there are some lenders that are sort of on the no risk loan, or the no collateral loans that are similar to a credit card. Those do not count. Again, as you will see as a trend, you must have had that loan in place before February 15th of this year. There has to be written documentation. So, your family loans, the loans with a neighbor where it's a handshake, they don't count. You must have written documentation. It must show that that loan existed before February 15th. Now, if you had, say, an operating line of credit that renewed sometime after February 15th, you paid it off subsequent to February 15th, and a new loan was made after that, doesn't count. It has to have been in existence prior to that February 15th. Another example would be that I had a piece of equipment that I had a loan on. I traded it in and continued to make payments, and they're virtually the same. Nope, new loan. It happened after February 15th, and as Aaron said before, no prepayments. You can't prepay your interest for the year and have it account. It must have been incurred or paid during the covered period.
Okay, rent is one we got a lot of questions about as well. It does include lease payments as well as rent, and on both real and personal property. You have to have paid it during the covered period. That alternative period was only for payroll. You can incur it during the covered period and pay it later on the normal schedule, even if that normal schedule means it gets paid outside the end of the covered period. Keep in mind, though, if you normally pay your rent, say in November, assuming your covered period ends before November, you can prorate your annual rent for the time that was within your covered period, okay? As long as you still pay it on that normal schedule. This must have been an obligation in place before February 15th, 2020 and have written documentation. Okay, so again, back to the handshake lease from a neighbor for a farm field, not going to count. And the way they're going to know is that if you claim rent as an eligible expense towards your forgiveness application, you must submit that written lease for forgiveness as part of your documentation. So if you don't have that, you're not going to be able to use that for forgiveness. You can't prepay rent and have it count. And again, remember the New York Times test. If you are looking to make a buck off of this, that's not going to turn out well, right? A lot of the big companies that were in the news who actually did the right thing just because they were big companies, right? They were the ones that were kind of raked over the coals on the front page, even though from what we can tell, they were following the rules. So if someone somewhere says, oh, let me up my rent to myself during my covered period, not going to play so well. And I don't think you'll be able to do that anyway, since that rental agreement wouldn't have been in place during February 15th. So again, concentrate on payroll because it is the Paycheck Protection Program, and that's really what the money was meant for, and it'll make your life a lot easier in terms of pulling together all the documentation. But if you need to, you can use rent, utilities, and interest.
So utilities. One of the big questions that we had early in the program is, well, what is a utility? So we do have definition. Specifically, is distribution of electricity, gas, water, transportation, telephone, or internet access. Those are the 6 subsets that count as a utility payment. Must be paid during the covered period. Alternative payroll covered period does not apply, or incurred and paid on time before your next regular billing date. So again, if you pay your electric bill monthly, you can prorate that last bill to account the days that were included in your covered period, as long as you pay that last electric bill on time. And again, those services must have been in place before February 15th, and it has to be before again, and you have written documentation. So these are pretty straightforward. The biggest one that has a little bit of confusion in it still is the transportation expense. You know, does that count for fuel for over the road? Well, if it's for fuel for a truck that I use to transport goods or people to and from work, then yeah, probably it does. If it's fuel for tractors that are used in my fields, well, that's not transportation, that's equipment. So again, as we've said multiple times, payroll is going to be your most important expense to focus on with the 24 weeks. Some of those questions you may not have to bother with in terms of, you know, whether this counts for transportation or not.
To recap, the non-payroll costs that are eligible for up to 40% of your PPP loan forgiveness, but hopefully won't even take up that much, right? You can use it for mortgage interest, right? Secured loan interest, rent, and utilities. They only count during your covered period, so that's starting the day you got the money, ending 24 weeks later. They must be paid or incurred and paid on schedule. They must have been in place with written arrangements and documentation that's all dated prior to February 15th, 2020. Okay, so if you keep those in mind, you'll be in good shape to know what counts and what doesn't.
So in the recap, is a really big picture of what's eligible for PPP loan. It's the amount that you spend on payroll that determines the maximum amount eligible for forgiveness. So if you get no other message out of today's discussion, it's that what you spend on payroll is really important. So important that you take the forgiveness application directs you to take the amount that you spent on payroll and divide by 0.60, i.e. 60%, That's the maximum amount of loan forgiveness that you can receive. So if you spend less than 60%, all of your expense forgiveness will be reduced, even if you spent the rest of the loan funds on those eligible non-payroll expenses. So in other words, you can't spend more than 40% of your loan amount on non-payroll expenses and still get full forgiveness if you did not spend at least 60% on payroll. So again, payroll is very important when it comes to the Paycheck Protection Program.
So which expenses should I use for forgiveness? Right? A really good way to deal with a government program is to do exactly what they ask for, nothing more, nothing less. Follow the simple instructions. So if you have a best practice of spending 100% on payroll, again, your loan was based on 10 weeks of payroll, you should be able to spend that no problem in 24 weeks. That means you're only going to need to submit payroll documentation with your forgiveness application.
So again, more of what should you use for forgiveness. If you only use payroll, you do not have to report any non-payroll expenses. You must document payroll. Every single person with their PPP loan application will have to submit very similar payroll documentation. It's required for everybody, regardless of whether you spent 60%, 70%, or 100% on payroll. So we look at it from the standpoint, if you want to minimize the amount of documentation that you need to submit with your application, spend it all on payroll, because then you will minimize the amount of documentation you need. If you need to spend more, if you don't achieve full forgiveness with payroll, then you'll be able to use those non-payroll expenses, but there's additional documentation to use. So again, payroll is very important.
So, step one, figure your eligible costs, right? So all the payroll that we've been through and the other three if you need them. And we need to adjust for any reductions in wages and salaries. If you were cutting pay or cutting hours and did not restore those jobs or pay amounts by the end of your covered period or the end of the year, then you are by the end of the covered period or the time which you apply, there could be forgiveness implications, right? If you got an EIDL advance, as I mentioned before, SBA will automatically reduce your PPP forgiveness by that amount. You can't have two trips to the free money well. And overall, the amount spent on eligible payroll costs is really what we're going to concentrate on. And then you need to complete the form with the math, which sounds simple, but there was, 11 pages when it first came out, Keith?
Yeah, and they reduced it, but the documentation is pretty much the same. They just use smaller words. So, for your rate of pay reduction, there are two main ways that your forgiveness can be reduced. Actually, three when you count the 60% threshold. But there are other, even if you spend more than 60%, you can have your forgiveness reduced if you don't keep people paid and if you don't keep them employed. So for each employee, and this is employee by employee, if an individual's pay rate was reduced by 25% or more when comparing that average pay rate for January 1st to March 31st to your covered period or alternative covered period, and you did not restore them to the same rate of pay that they received in that reference period of January to March, then your forgiveness will be reduced by a comparable percentage. So bottom line is keep your people paid and to the same amount.
Now, there is a safe harbor, okay? If you were able to maintain the rate of pay in place since January 1st, or you're able to restore those pre-March salary or wage levels by the end of the year or when you apply for forgiveness, then you are going to be able to fall under a safe harbor and not have forgiveness reduced. Now, there is a caution. If you raised wages between February 15th and March 26th, and I know a lot of employers do that at the beginning of an agricultural season, If you did that and then reduced the pay rates after you got your PPP funds, the safe harbor won't apply to you. You have to bring those folks back to 100% of the new raise rate that you gave them in that time period in order for the safe harbor to apply there and not have forgiveness be reduced.
So what about these elusive full-time equivalents? The first step is you choose your reference period, and you have choices. Every PPP borrower has the choice of using either February 15th to June 30th of last year or January 1st to February 29th of this year. And then if you applied for your PPP loan as a seasonal employer, and this is key, doesn't have anything to do with whether you believe that you are seasonal or not, or whether or not you meet some definition of seasonal in forgiveness period. It's specifically if you applied using the seasonal employer rules for your loan application. You do have the additional choice of a consecutive 12-week period between May 1st and September 15th of last year as a reference period. Our hint is pick the one of those reference periods that has the lowest FTEs, and we're going to show you how that is calculated in a bit. But you want that number to be the lowest because that's what you're comparing against for your covered period or alternative payroll covered period. You want the FTEs in your covered period or alternative payroll covered period to be higher than they were during that reference period to avoid a reduction.
How do you calculate full-time equivalent? Well, first, you got to list each employee, and that is the way it's going to work up for a table on your forgiveness application. Then you're going to list the hours they worked each week during the period of time for which you are calculating this, and find the average hours they worked per week. Now, this is going to be a little tricky because time periods like January 1st through February 29th are not an even number of weeks. And SBA has said they will issue more guidance on exactly how they want that to be. Do you divide by 8.3 weeks or some other number? And once you have the average hours per week, you need to divide by 40. That'll give you your full-time equivalent. You get to round to the nearest tenth. That is your FTE count. So if I was 40 hours a week straight through, I would be 1 FTE. If I was more than 40 hours a week, I still only count as 1 FTE. So those employees who were working overtime to pitch in during COVID when there was just more work between cleaning, disinfecting, keeping everything distanced, all of that, they still count as 1 FTE, even if you were paying them overtime.
So there are some exceptions to the FTE reduction. So if you have anyone who you made an offer to rehire, so say you laid someone off and there's someone specifically who is on the books as an employee prior to February 15th or on February 15th specifically, and you were unable to rehire them or a similarly qualified individual, and this is something that's been sort of redefined as the rules have evolved. Originally it was you had to rehire the individual, but now they've expanded that to say even if you can't find someone who is similarly qualified by 12/31, then that individual would be removed from your FTE calculation. You would not be penalized for that loss of an FTE. Any position that you made a good faith written, notice they say written offer to restore reduced hours at that same rate of pay, and the employee rejected the hours. So say you had when COVID hit and some of the restrictions hit, you reduced hours and you offered to bring the person back, and the person said, well, no, my kids are home from school and I need to help with school. I can't come back to the same level. I need to continue to work part-time. Now, at that point, you get it all in writing, document it. That one doesn't count towards your FTE reduction. And then, again, any employee who was fired for a cause, sometimes we need to still let people go because they're just not doing a good job. That's not going to come back to bite you. Anyone who resigned or voluntarily requested a reduction in hours. So the key with these all are make sure you have good documentation in place of any of these scenarios. because you're going to be asked to prove it.
So again, document. First, if someone rejected a job, right, after you made a good faith effort to rehire them, if you fired them for cause, if they voluntarily resign, right, people are still moving, people are still getting new jobs and traveling with their spouses to where that new job is, even though there's COVID going on, right? If they voluntarily requested a reduction in hours for whatever reason, make sure you get all that in writing. And if these are the reasons the FTEs are reduced, it does not count against you, does not reduce your loan forgiveness. You don't even need to report it if you fill the position with a new employee. But again, document it all in writing.
So in addition to the exceptions to the FTE reduction, there is also a safe harbor. So if you reduced FTEs between February 15th and April 26th, and they are very specific to those dates, and you restored to the level of FTEs that you had on February 15th, the pay period that included February 15th by December 31st, or when you apply for forgiveness, if that is earlier, your forgiveness will not be reduced due to the FTE reductions. Now, if you don't meet that, the reduction is proportional based on the decrease in FTEs. Now, one important note, this FTE count that we're talking about has absolutely no correlation to that employee number that you put on that loan application. When you were asked how many employees did you have on the books on February 15th, is the way it was worded in some places. I think that's the way it was worded on the official SBA application. That number has no correlation with anything related to FTE forgiveness. We thought it would when that form was out there, but we've come to realize that number really has no correlation to anything related to forgiveness. So I just want to make sure we point that out.
Right. It was more a check that you were in business and that you had employees on February 15th, that you were eligible, and even the owner of the business as a sole proprietor counted as an employee for that time or for that answer. So you're good to go with that. All right, no reduction also, right, here's another way that you don't get dinged, is if you can document that you were unable to operate between your February 15th and the end of your covered period at the same level of business, right, due to compliance with COVID-19 safety requirements. All right, so if you were under a government order to shut down for whatever reason, and a lot of places were deemed non-essential, right, or couldn't sell their product, couldn't be open for business, right, that's something that will not count against you if you couldn't have people coming to work. And you have both of these conditions met. You reduced your FTE levels between February 15th and April 26th, and you restored them to the February 15th levels by the end of the year. So again, you need to have the end of the year passed so that you can prove that you've done that if you haven't already.
So again, if you don't meet either of those safe harbors, that reduction will be proportional based on a decrease in FTEs. Basically, you take the FTEs during your covered period and you divide by the reference period, and that becomes a fraction that you apply towards your forgiveness amount. So if you were 80% of the FTEs in your covered period compared to your lowest reference period, then your forgiveness amount is going to be reduced by 20%.
What about owner comp? If you included eligible owner comp, as we said before, you have to be very careful that you only use the amount that was specified by your 2019 tax return. This is a question we get a lot, which is why we want to hit it again, make sure everybody is very clear. It doesn't matter if you paid yourself minimum wage last year and this year things are going better. You can certainly do that. It's your money as the owner. However, it doesn't help your forgiveness application.
So how does owner compensation relate to forgiveness? That owner compensation replacement, again, is based on, depending on what business structure you have. If you're a corporation, and this is either an S or a C Corp, it's that owner or officer salary, but you're limited to what you were paid in 2019. If you gave yourself a raise in 2020, You can't use the new rate. You use what you were paid in 2019. Again, they're trying to avoid business owners having windfalls due to the PPP program. That is not the intent. The intent is to get money into people's paychecks. Partnerships. Again, it's that box 14A of the 2019 return, the one that you actually filed. Sole proprietorships, that's your Schedule C or F, and it's the profit amount. So if you had a loss on Schedule C or F, then there's nothing eligible for forgiveness. And again, it's what you filed with your 2019 for your 2019 tax return. And then if you use an 8-week covered period, remember we said you could elect to use that 8-week covered period. You use all the rules. You can't pick and choose. So if you elect to use the 8-week covered period because you just want to get this thing over with, you're limited to 8 weeks of owner compensation. Of those amounts listed above, you take that amount. Say you made, $50,000 of profit in a year, or as a sole proprietor, you divide by 52, multiply by 8. That's the amount. Now, if you're using the 24-week covered period, it's 2.5 months of owner compensation replacement. So you take that amount, that 50,000 in the example, divide by 12, multiply by 2.5. And then if you exclude any sick leave equivalent for which a credit is claimed. So if you claimed owner's a tax credit for sick leave as an owner, which was one of the programs that's out there, you have to exclude that amount.
Benefits are another part because, as you recall, when you applied, you were allowed to include health care and retirement benefits. So what does that mean for owners? The SBA has been very clear that C Corps may include company-paid health and retirement benefits. S Corps may include company-paid retirement benefits only. They say that is because the healthcare benefit comes through on the K-1 calculation. For an S Corp. Sole proprietorships and partnerships may not include any health or retirement benefits. And SBA's justification for this is that you use that Schedule F or C profit or your partnership money that comes through on your K-1 to pay for those different expenses. So if you were getting to add them as well, you would be double counting. Now, is this how life works in the real world? Not exactly. Unfortunately, these are the rules the way they've been addressed.
So what about timing? When should you apply for forgiveness? Now, the rules do state that a borrower may submit that application anytime on or before the maturity date of the loan, including before the end of the covered period. You don't have to wait till the end of that 24 weeks. If you have spent all the money that you are going to spend on eligible expenses. So if you've used up your loan funds on these eligible payroll and non-payroll expenses, you can go ahead and apply. Now, there's some caveats here that we have to point out. If you reduced your rate of pay for any employees, that still applies. And if you reduced FTEs during that covered period, that will still be reduced. Now, one of the big questions that there's not really an answer to is how will the FTE reduction be calculated if you use less than a full covered period? All the math that they direct us to do and all the forms and all the instructions to the forms direct us to use the FTE for the entire covered period. It's very clear how they give those instructions. How does that apply to someone who applied on week 10 or week 12 or week 14 of a 24-week covered period? We simply don't know. We're hoping that we get some clarity on that from SBA. Now, they did address the rate of pay reduction. That's essentially if you reduce the rate of pay, that proportional reduction gets carried forward as if it had existed for the entire covered period. So stay tuned. We hope to have better clarity on the FTE reduction. And you need to have all that appropriate documentation. So as Aaron pointed out earlier in this discussion, when we're talking about tax documentation, if you need some payroll tax filings, say if you need your quarterlies or even that 943 is an annual filing, you got to wait until those have been filed before you can submit them as documentation. So keep that in mind in terms of choosing when you're going to submit your application.
So what documentation do you need? If you haven't already, start a PPP forgiveness file, and as things are coming across your desk, make sure you're sticking them in there. You're going to have to keep all of this information for 6 years from the date that the loan is either forgiven or repaid in full, which means 2027 for most of us, because a lot of the forgiveness is going to happen in 2021. You're going to need documentation that has been acknowledged through a third party. So invoices and receipts, or the bills you receive and the payments you made that are documented by a canceled check, which has been passed through a bank, right? Or account statements from a third party that shows, for instance, lease payments and when that lease was originated. Those are all considered third party, so you're not just in making your own documentation. It needs to come from somewhere else. Can't just be your own internal records.
What do we need to document for our payroll dollars? And let's make sure we're clear on this one, because as we've said, everyone is required to submit payroll documentation regardless of how much of your forgiveness application amount is going to be comprised of payroll. So you must include bank account statements or third-party payroll service provider reports. So if you're using, Farm Credit East to process your payroll, if you're using Paychecks or one of the other providers out there to do your payroll for you as a third party, a report that they have that shows that the amounts that were paid to your employees, they can be replaced for your own bank account statements. You also need to submit the tax forms, the federal tax forms, or the equivalent third-party payroll provider. So again, if you're using a third-party payroll provider and you can get a report from them that is the same as a Form 941 or Form 943 in terms of the information provided, you can utilize that. But if you're doing the payroll in-house, you're going to be required to submit those 941s, those 943s. And again, 943s, it's an annual filed report. If you're doing your own payroll and nothing changes, you're going to have to wait till January until after you submit that 943 to be able to apply. And that's a capital and, you must also submit all of your state quarterly business wage reporting, your state unemployment insurance, tax filings, etc., need to be submitted in addition to that. So again, those quarterlies, you're going to have to make sure that you've got all the appropriate documentation that overlaps your covered period. And the way things fall, you're probably going to be waiting until October at the least to get those quarterlies. And then you're also going to need payments, receipts, canceled checks, account statements for those employer contributions to health insurance plans and the employee retirement plans. So you need, if you can get an account statement from your health insurance provider that shows the amounts paid specifically towards employees by the employer, if it's broken out, that can suffice. But if not, you're going to need to show, the receipts or canceled checks and canceled checks for your own filings. A QuickBooks report or a CenterPoint report from your own records will not suffice.
For FTEs, you are going to have to document the average number of FTEs from February 15th through June 30 last year, or from January 1st through February 29th this year, or if and only if you were applied and approved as a seasonal business for your PPP loan. Not if you consider yourself seasonal, but this is how your application was processed. You also have the option of 12 consecutive weeks between May 1st and September 15th of last year to do the FTE reference period. And for that, documents may include any of the payroll tax filings, like your 941 or 943, and state quarterly business filings for wage reporting, unemployment, etc. Okay. Now, if you are a 943 filer stay tuned because right now you do need to wait until January until you file your 943. However, our Knowledge Exchange team has put together some talking points for you if you'd like to grab them off of Farm Credit East's website so that you can write to your Congress people and to your local SBA office to ask, is there an alternative for me so that I might apply in a more expedient fashion before waiting for the end of the year? You can look that up when the webinar is over.
So yeah, just a little more detail on the 943. Yeah, we know it's an issue. Just remember, SBA, they don't work with farmers. That's not their normal thing. It's the first time they've ever really done any serious work with farm businesses, because normally that's what FSA does or your other USDA offices. So they just simply don't know that 943 even exists, more than likely. So, as Aaron pointed out, we do have talking points on Farm Credit East. So if you're really wanting to get this resolved so that you can get an application for forgiveness in prior to January, go ahead and give your regional SBA office a shout and look at some of those talking points to maybe put a little pressure on to get this answer to this question.
What other payroll records do you need to keep? You need a list of employees who are on payroll during your chosen covered period who reside in the U.S. On Table 1, if you've been following along on our weekly office hours, you have most of this done already. Table 1 is going to be employees whose cash compensation, including bonuses, was less than $19.23 a week for every pay period in 2019, or employees who are not on your 2019 payroll, they were new to you in 2020. So what we're doing here is we're looking for folks who did not exceed $100,000 a year annualized, meaning in any one pay period. So if you paid a bonus that kicked them into that amount, they were above $19.23 a week, then they get put on Table 2, which is employees who hit that threshold in at least one pay period during the previous reference period. Why is that good? These employees aren't going to be subject to the wage reduction test. So if you paid a bonus late in 2019, you are not going to have that held against you because the rate of pay would not be the same as the year changed and you went back to the regular rate of pay. And then if you've got more than one business owner, you're going to need a third table for the owners because, again, your compensation counts as specifically outlined earlier, but your hours do not count towards FTE. So SBA wants to see owners separate.
So again, a little more detail on what specific payroll records you're going to need to keep and submit with your application. You're going to need for each of those tables, you're going to need the employee name, some sort of employee ID, probably the last 4 digits of the Social Security number, any cash compensation that they received, their average FTEs during the covered period, and then the salary and wage reduction that was applied, and that's only for Table 1. Again, Table 2 are the folks who are exempted from the salary and wage reduction factor because they earned more than the equivalent of $100,000 in any given pay period last year. So then you'll take those that information that's in those tables and you compare to your covered period to January 1st to March 31st. That's the realized rate of pay. And then you'll also compare to February 15th and April 26th to see if you qualify for the safe harbor for the rate of pay reduction.
What do you document for rent and interest? Again, we talked about those written obligations that were in place before February 15th, 2020, and any canceled checks or receipts that show you made payments toward these obligations. Or if you can get an account statement from your lessor for February 2020 to show that you had that obligation in place already, all the way through the end of your covered period plus the next month, because again, you may have payments incurred but not yet paid during your covered period. That will suffice for rent or lease. And same thing with mortgage interest. Either you need a lender amortization schedule and the receipts or canceled checks, or the account statements, again, starting in February, going through the month after your covered period ends.
So what about utilities? If you are going to be using some utilities, payments and utilities as part of your eligible expense for forgiveness, you'll need copies of invoices from February of this year and during the covered period. That's establishing that that service was in place in February. And you'll also need receipts, canceled checks, or account statements. So if you're using your electric bill, you'll need that account statement that not only shows what was due, but what was paid and when. And again, as a reminder, electricity, gas, water, transportation expense, telephone, or internet access are all eligible for utilities.
So there's an easy form out there, and I've had quite a few people say to me, "Oh, Erin, this is going to make it so much easier." Well, I've cautioned them that they should probably go read the instructions before they say that, because easy is a relative term. So the number of pages of the application form got reduced, but the documentation required did not. So all you're doing is making less work for your lender. Keep that in mind. You may use the easy form if you were self-employed and had no employees at the time of your PPP loan application, which means it was only your Schedule F or Schedule C that you applied based on. You also have the opportunity to use the easy form if you did not reduce the average compensation of any employee by more than 25% when comparing your covered period versus the first quarter of this year, and you did not reduce the number of employees or average paid hours between the beginning of this year and the end of your covered period, or you didn't reduce average compensation by more than 25%, comparing those two periods, and you were unable to operate as you were earlier this year due to compliance with COVID-19 restrictions. So there's a lot of us who were not able to operate because of COVID-19 restrictions. You have to be able to document all of those, of course, in writing before that counts, okay? So don't think that if you don't fall into one of these categories that you're saving a whole lot of time and paperwork. You still have got to do all the math and the documentation that Keith's going to get us into.
Yep. So, to kind of sum up, what are the key differences between that EZ form, and that's a relative term, again, as Erin pointed out, versus a regular form? Really, the only main difference is that the EZ form requires less documentation to be submitted with your application. You still need to have all the same documentation in place. You just have less that you send along. So as Erin pointed out, it's really only saving work for the lender, as they will be able to have less that they need to review on that EZ form versus the long form. You still need to be able to document. You still need to have that documentation in place, because SBA, up to 6 years after the end of your loan forgiveness or the end of your loan payoff, can come back at any time and ask for a review of your loan file. And you still got to do the math, because you got to confirm that you're going to be able to answer those questions truthfully, that's certified that you're eligible to use the EZ form. So all the math is still required. The documentation is required to have, not necessarily to submit. And like I said, SBA has that 6 years. They can look at anything and everything associated with your PPP loan, including the documentation you had in place for the loan application. So don't throw anything away. Put it in a good, safe place where you can find it, because they could come asking for it. And in fact, we know that any loan over $2 million, SBA has already said they're automatically going to review those. The other loans, not so sure how aggressive they're going to be, but need to keep that documentation in place, just as if it was information associated with a tax return.
Mm-hmm. Fishing vessels are already going to be subject to a tighter review because of the way that crews are paid. There's some potential discrepancy there, so it could be industry-based. So we've got to keep that in mind, and we want to make sure everybody is prepared with exactly what they need when the time comes, because I think it's going to be a when, not necessarily an if. So you still have to submit, or you still have to maintain this documentation even if you don't need to submit it. So you need to support the wages and salary rates. of your covered period during the first quarter, you need to submit or you need to include in your package, but not submit job offers and refusals of employment or restoration of hours through the end of this year. If you did not reduce employee numbers or paid hours, that also needs to be included in there. And if you did, certainly document that as well, because you don't want SBA to come back and say, hold on a second, we think your forgiveness should be reduced even further. If you are unable to document, or if you are unable to operate because of COVID compliance, safety rules and regulations, definitely document that. Grab a copy of your state executive order, keep that in your file. And everything else related to your PPP loan, including your application documentation. That is going to be super important, especially for those that were filing based on draft tax returns. So you want to keep that all very close by and easily accessible for your PPP information when SBA asks.
So we've all heard that there's two certainties of life, and one of them is taxes. And so we know folks who have questions about taxes, so and how this all this program interacts. So written into the original law was the fact that any loan amount that is forgiven by SBA, in other words, it becomes a grant, is not considered taxable income. You will not be taxed on that. If you received a $100,000 PPP loan and you achieve forgiveness for that full $100,000, that loan forgiveness will not be taxable income, which loan forgiveness normally is considered taxable income. If you had a loan with a bank and for whatever reason they forgave that debt, that would be considered income on a tax return. But in this case, for this program, that's not considered income. However, IRS has issued a ruling that said that expenses that you use to qualify for forgiveness will not be tax deductible. So if, again, that $100,000 PPP loan, let's say you used it all with payroll, you'll have $100,000 worth of payroll expense that will not be able to, that you will not be able to deduct on your 2020 tax return. So what does this mean? This means that your taxable income will be higher as a result of receiving this, free government money essentially. But you still will be able to keep more than you paid in taxes. So let's say that your marginal tax rate or your average, your realized tax rate is 25%, and you had a $100,000 loan. From a net cash flow standpoint, you'll still be a positive $75,000 after all the dust settles and after the taxes are filed next year as a result of this. So that's where we stand. There's some rumblings that could change, but as of this time, that's the circumstance, so that there's no surprises when you get to putting your tax return together for 2020.
So what's next? We already said mark your calendars with your 24-week covered period and or the alternative period if you choose to use that to simplify payroll record keeping. Make sure if you haven't already, you start this documentation file, even if it's making a list of the reports you need to run and gather when your covered period is over. You're going to need payroll tax filings that overlap your covered period, no matter which expenses you're claiming, because you have to use payroll. So that may mean waiting until the end of the third quarter, may mean waiting until the end of the year, depending on which payroll forms you file. And again, we'll be working on this until we get forgiveness achieved for everybody who wants it. So we will be keeping you updated with any changes that come along. But that's what we need to be working on now.
So maybe you need a little more assistance with this loan forgiveness. Maybe we didn't answer all your questions during this process, or you just simply, hey, I want somebody to do this for me because I don't have time for this. So no matter what assistance you need, we probably have something or someone that can help here. So every Wednesday at 9, I imagine a number of folks that are on this call have been participating in that, but every Wednesday at 9, again, as Aaron said, until the last Farm Credit East customer gets their loan forgiven, we'll be doing these weekly call-in webinars at 9 a.m. We limit those to an hour, and that's where we give you updates on anything that has changed in the last week, any new rulings from SBA, any rules that have changed, any guidance whatsoever. And we're there to answer your questions. That's a free resource that we're offering, again, every Wednesday at 9 a.m. If you go to farmcrediteast.com/webinars, you can find the information on how to sign up for that. Let's say you want a little more help. You want some one-on-one work with a consultant to answer your specific questions related to your application, or maybe you just want, again, to pay somebody to just take this off my hands and fill out all this paperwork for me, get the documentation together, and get it ready for me to sign and send to my lender. We are able to provide that service for you. It will be on a fee basis. If you're interested in that, there's a spot on the Farm Credit East website. You see the link there. It's farmcrediteast.com/PPP consult. There's a form you can fill out. You submit that with your some basic information, and one of us will be back in touch with you to take it from there.
And with that, we'll turn it back to Chris to moderate the questions that you have that we didn't answer yet. So fire away, Chris.
Okay, thank you very much, Keith and Erin, for that very thorough and informative presentation. We're already bumping up against our 12:30 time, but we're going to go over a bit to get to as many of the questions that were chatted in as we can. For people that have to leave the webinar due to conflicts or whatever, keep in mind that this will be archived at farmcrediteast.com/webinars for future viewing. Just to minimize background noise, I'm going to quickly mute everyone and then unmute our presenters. So just we may go quiet for 30 seconds here. Okay, so we should be good now. Keith, and Keith and Erin, I unmuted you, and I should be unmuted as well. Okay, so a couple of questions here have come in about self-employed or sole proprietor businesses. Should they be writing themselves a payroll check, and how frequently for the purposes of the forgiveness? And that may vary depending on their legal form, correct?
Actually, there's not, as we understand the program, how the forgiveness will work for business owners, your forgiveness formula has already been written. It's based on your 2019 compensation. So if you're a corporation, you paid yourself a certain amount in 2019, that's the amount that you can claim in 2020, and that's your documentation is your 2019 payroll data for the owners. Same thing with your sole proprietorships and your partnerships or the LLCs that are taxed that way. Your documentation for your loan forgiveness is based on what happened last year. And SBA explains that by saying they did not want to create an opportunity for a windfall for an owner. You know, think about it. An owner gives himself a raise when they got this money. They didn't want to create an opportunity for that. They wanted to compensate owners based on what they were paid prior to this whole COVID thing. So they based it on what you did in 2019. So there's no requirement of documentation that an owner actually paid themselves in 2020. It's based on what happened in 2019.
Okay, thanks. Question about FTEs. We lost an FTE due to firing for cause, or I imagine it would be the same for a voluntary leave. That employee's hours were made up by the full-time workers, so we could not capture the terminated employee's FTE who was part-time. But we just hired a new part-time employee to replace him. Should we still record 15 FTEs as we did on the application since his separation from us was for cause? Do you follow that?
A couple of different pieces here, okay? Remember, forgiveness versus application counts do not have anything to do with each other. One was a head count, one is an FTE calculation. So you're going to have to keep your application for the loan and all that documentation, but you're going to have to do a whole lot more work here to document FTE. Now, someone fired for cause. We said if that was one of the included reasons, and you documented that properly, that is not going to count against you. You are not going to get any additional credit because the existing employees picked up all of that work. But if you did hire another part-timer to replace that person, then you're actually going to have a higher FTE count, right, than you would have otherwise. Because again, that firing is not for cause, is not going to be counted against you. So it sounds like you're all set.
Okay. A question regarding rate of pay calculation. Is it their rate of pay per hour, say $15 an hour, or is it their gross pay, like rate of pay times the hours they worked? That matters.
The way that all the formulas work, it's what I'm calling realized rate of pay, because all the formulas that are in the forgiveness application talk about you report the amount that their gross pay and then divide by the hours worked to get to their average rate of pay. And so if someone was working overtime, for example, was getting paid overtime, that's going to bump their rate of pay up. And then you compare that to what happened in the covered period. And so that's something to keep in mind, is that if you're that reference period, the first quarter of this year, you had people working a lot of overtime, and then that didn't happen during the covered period, it could affect that rate of pay per employee. And again, it's an employee by employee calculation. You're looking at Bob, you're looking at Fred, you're looking at Sally, you're looking at Linda, you're looking at what they individually made on an average basis versus the aggregate, which is how the FTE calculation works.
Okay. Question about timing of forgiveness applications. Two parts. One is, do you know of any lenders that are actually taking applications now at this time? And B, is there a reason to want to do it now versus waiting?
I do not personally know of any lenders that are taking applications. I've gotten several reports of, oh, my lender emailed me and said, get ready to apply for forgiveness. I need to do this now. And then you get to the fine print, which says, we just want you to be ready. We're not taking applications yet. And the reason for that is SBA has not determined the full process for which a lender needs to go through once they have accepted an application in order to submit it to SBA, yet it starts a clock ticking on a lender, and there will be penalties if they don't meet that time frame. So why start the clock if you're not going to be able to do anything with it? And then next, is there any reason to rush? Well, it's always painful to buy the first model year of a new truck, isn't it? Somebody's got to figure out the bugs, and I expect we'll be doing that a bit with the forgiveness. So we want to caution you not to wait until the last minute, because you don't want to get stuck in a pile of paperwork on an overworked government employee's desk. But on the other hand, there's no reason to rush right now, because unless you are doing the 8-week covered period and it ended before June 30th, and you filed all of your second quarter payroll reports so far, you can't apply anyway, because you still need to wait for the third quarter or fourth quarter to end, so you'll have the appropriate documentation. So for most of us, I think we're going to be looking at this starting in October and more likely January.
And along those lines of the timing, how does the interest work? Does the interest accrue and needs to be paid based on the time, or is there a grace period, or what?
I believe interest accrues from the beginning of the loan. However, the interest is included in the forgiveness. If you achieve full forgiveness, interest is forgiven as well. However, if you are, say, you have a portion of the loan that is not forgiven, anywhere from 1% to 100%, that remains as a loan, the interest that is accrued will be applied as if it existed from the very beginning. So you all started accruing interest the day that you got the loan. There's not a deferment on interest. There's a deferment on when the payment is due. So again, the first payment is due there will be no payment due until after loan forgiveness status is determined by SBA as long as you make your application no later than 10 months after the last day of your covered period, that 24 weeks. So due to math, 24 weeks is kind of like 6 months. It's not exactly 6 months, and 10 months is kind of 10 months. So 15 to 16 months after you got your money is when the first payment would be due. And then if you fill out and submit that application ahead of prior to that, there's no payment due until after that. But interest is accruing from day one, and so it would be, if you anticipate that you're going to have a loan balance, you might want to get some of that that loan, start your loan payment schedule earlier, simply because you'll be paying less interest as an aggregate, because the loan interest is accruing from day one.
Okay, but keep in mind it's only at what, 1%?
Yeah, it's 1%.
Okay. Little bit of an unusual scenario here. Since our income comes in inconsistently, we pay some of our employees way in advance, up to 1 year. Can we still use this for forgiveness?
It says in the regs that you need to have the payroll be incurred during the covered period and paid before the next regularly scheduled pay date. Now, I'm not a payroll expert in terms of how far in advance you're allowed to pay. I know you're not allowed to pay really late. So that's one I think we'd like to take a little bit closer look at. But if you were paying someone in the covered period now for work that goes through the rest of the year, I don't know, Keith, I think the prepayment restriction would kick us out of that one. What do you think?
Yeah, I agree. It's incurred and paid as due. So, if you're paying someone, I think you need to look at what they're going to want you to follow, the payroll rules for one thing. So we'd have to look at that. But, let's say you pay somebody 6 months at a time. I'm just making up a scenario here. Or a full years at a time. You pay them one lump sum for their year's worth of wages. Let's just throw that scenario out there. You're only going to be able to count 24 weeks of that. So you're going to have to prorate it. Even if you might not have to show that you paid it until the end of the year, as long as that's kosher in terms of payroll documentation. But only you can't make a prepayment during that covered period and make it count. That's not going to work.
Okay. Question about how to determine the interest costs on a loan. And for that, I imagine any lender, if you look at the statement or the bill, it should specify what interest and what principal, correct?
Absolutely. So, my advice on if you're going to be using interest expense is get an account statement from your lender that breaks out the principal and interest amount and shows the amount that you paid. That's going to be the simplest documentation for you. And again, if you go through any sort of a bank, any sort of a lender, they can do that for you. The other question is, well, what about a loan that I have that's, with a private individual? Well, there's a lot more documentation necessary for that, because you're going to have to show an amortization schedule. And, if you didn't have one, well, that might be a problem. So, but yeah, any lender can show you that, even if it doesn't show on your regular schedule.
Okay. Question about the easy forgiveness form. Is that available for sole proprietors or other entities? Is there any restriction on the entity that can use that?
Nope, we went through the restriction already. Sole proprietors who do not have any employees and only applied for their PPP loan based on their own Schedule F or C profit can use the easy form. That restriction is available, or those documentation pieces are available right on that PPP application. So you can take a look at that and see if you qualify.
Okay. Question came in about the Form 943 or a third-party documentation for a payroll provider. what documentation exactly would be the equivalent of that Form 943?
So the Form 943 or 941, either one, they show they list every employee that you that you had employed during the time period you're filing for. They show how much you paid them. They show the hours worked. They show the withholding, that sort of thing. If you work with a payroll provider, they will, chances are they're already working on the form. I know the groups that we work with, the companies that provide the payroll services and programs and software for the payroll that Farm Credit East processes is already working on those reports. I am positive that any of the other major payroll providers out there are doing the same thing and probably have already got the reports ready. So that should be directed to them specifically. But yeah, it's basically looking at, when you look at that payroll tax report, looking at basically every line that's on there, making sure that there's an equivalent, because the SBA says, or an equivalent report from your payroll provider. So when I think equivalent, I think anything that's reported on the tax document should be reported on that payroll provider report, and they can certainly, your payroll providers will certainly be able to pull them together for you.
Okay, great. If you had a lease that was due May 1st and you paid in advance, but you didn't get your loan until May 1st, would that lease be eligible as an expense?
So you were leasing a piece of equipment and then you bought it out and got the loan?
No, you had a lease payment due May 1st, and that's the date you got your loan, but you had previously made that payment back in April.
So the lease got paid early before you got your PPP money. I'm looking at that as saying it needs to be paid. Right. Go ahead.
Clarity is important here. So by loan, meaning PPP loan. So if you paid something prior to your covered period, no, that part does not count.
Right. It could have been incurred prior to the cover period and paid in, but not the other way around.
Okay. Question about the 8 weeks versus 24 weeks. If I use my PPP loan completely within the first 8 weeks, do I still need to consider the 24-week payroll factors for that forgiveness?
If you used all of, go ahead.
No, if you used all the funds in 8 weeks, 75% or more was payroll, because remember, you need to use all the rules associated with the 8 weeks, all the original rules. So 75% or more towards payroll and, et cetera. Then yeah, you can elect to use the 8-week covered period. You have a 24-week covered period by default. Every single loan got converted to a 24-week covered period. It was just the exception that those loans that were originally made with the 8-week rule in place can elect to use 8 weeks instead. So yeah, you can do that. You do not, but again, it's one or the other. You don't get to cherry pick. We've had some confusion on this where folks says, oh, well, I'll use my 8 weeks, but I only had to spend 60% on payroll. Unfortunately, that's not how it works. If you choose the 8 weeks, you have to use all the rules associated with 8 weeks, including the 75% payroll threshold.
Right. So just as a refresher, June 5th is that magic date. If you got your money before June 5th, your PPP funds hit your bank account before that date, you have the option of the 8-week covered period. If it was after June 5th, right, and that's the starting date for you, then you automatically have the 24-week period and no other option. You can certainly apply sooner once SBA gives us the forgiveness rules so that you can complete your application adequately, but it's the earlier ones that have the 8-week option also.
Okay. Question would we be able to post some sample calculations somewhere on our website or something of like examples of FTE calculations and that sort of thing for this for hypothetical businesses as a guide.
We do that every week at office hours. Come join us.
Yep.
Okay. Question about, you mentioned that if your business has reduced FTEs due to a mandatory shutdown, COVID related, that doesn't affect your forgiveness, correct?
Right.
But what if your customers are, sorry, go ahead.
No, just go ahead. Go ahead.
What if your customers are shut down and that prevents your ability to work and supply them? Would you be sort of covered?
So that's an I've thought of that question, and that's a bit of a gray area, quite frankly. The way that it's worded that particular nuance was added with the Flexibility Act that was passed there in June, and it talks about your business, the business that got the loan, being unable to operate due to compliance with COVID-19, CDC recommendations, et cetera, which implies that the business itself was unable to operate, and it's unable to operate at full or even limited capacity. So I believe personally, this is why we put disclaimers, because this is my personal belief. I believe that an argument could be made that because you couldn't sell to your half of your customers were shut down. So take a produce supply, somebody grows produce and ships and sells to restaurants. There were many restaurants that are still unable to operate at full capacity and had to reduce their orders dramatically. I think there's a strong argument there that kind of fits in with the idea there. However, the way the rule reads literally, it may not count. So that's one of those questions that I think should be pointed and directed to a regional SBA office. Let them get the full picture for it and see if that can result in some better clarity, because I think that's beyond the scope of anything that we can authoritatively say for sure.
401k contributions, what's eligible and what's not?
So we go back to payroll costs. What was incurred during the covered period? So there you'll figure out what people earned. Right? That is going to be the employer's share during the covered period that was then paid during its normal course of business. And keep in mind, though, if you only make one contribution a year based on the entire year, even if you've prorated the amount, if you don't pay that amount until, say, the end of the year when you'd normally make a contribution, you won't be able to use that towards forgiveness until you've actually paid it, because you won't be able to document that it's happened.
So with that, I will wrap up and thank you all for your time. We really appreciate your attendance and your interest, and we're adjourned. Thank you.